Okay, let's dive right in. We're going to pull back the curtain on the deep and often hidden world of financial engineering. We're talking about the highly sophisticated strategies used to protect and grow massive fortunes. Strategies that go way beyond the tax concepts most of us deal with every day. You see, what we're really talking about here are two completely different tax worlds that exist at the exact same time. On one side, you've got the world we all know, paychecks, deductions, writing off business expenses. But on the other side, well, that's a parallel system built with a totally different set of tools. The goal isn't just to lower this year's tax bill, it's to fundamentally reshape how wealth moves and survives across generations. So, to really get a grip on that hidden world, we've got to start with what's familiar to all of us, right? This is the world where tax planning is mostly about making sure you claim every single legitimate deduction and write-off that you're entitled to. For most businesses, the strategy is pretty straightforward. You claim deductions for your real expenses to lower your taxable profit. Things like buying new equipment and using Section 179, or even a film production writing off its costs with bonus depreciation. And look, it works, but it's fundamentally about playing defense. It's about reducing this year's taxable income. What we're about to see is a system built entirely for offense, one that's designed to actively restructure the future of wealth itself. Okay, so now let's cross the bridge into that other world. This is where things get really interesting. Here, the goal isn't just about finding another deduction. It's about changing the very rules of how wealth behaves, using incredibly powerful instruments designed for one thing: high-impact results. All right, first up is this thing called a grantor retained annuity trust, or a GRAT. You can think of it as a kind of growth siphoning engine. The whole idea is to split an asset's future growth away from its tax bill. So, you put a fast-growing asset into this trust. The trust then pays you back the initial value over a few years. But here's the kicker. What if that asset absolutely explodes in value? Well, all of that incredible growth passes to your heirs completely outside of the estate tax system. And listen, this isn't just some textbook theory. This is real-world, high-stakes strategy. I mean, look at this. Mark Zuckerberg famously used GRATs before the Facebook IPO. By doing that, he was able to transfer the absolutely meteoric rise of that stock's value to the next generation, basically putting a shield around it to protect it from huge transfer taxes down the road. Next up, we've got a really clever tool that kind of blends doing good with doing well financially. It's called a charitable remainder trust. The best analogy is this. Imagine you give a priceless painting to a museum, but as part of the deal, the museum agrees to pay you a steady income for the rest of your life just for the right to officially own that painting later on. It's a win-win-win. You unlock the value of your asset, you support a cause you love, and you create a tax-smart income stream for yourself. So why would you do this? Well, here's the crucial part. A CRT lets you sell something really valuable, like your company or a property that's shot up in value, without getting hit by a massive capital gains tax right away. Instead, the trust sells it, and then it gets to reinvest the entire pre-tax amount to generate income for you. And you get a charitable deduction on top of the whole thing. It's an incredibly powerful way to handle a big sale. And now we get to the big one. The absolute cornerstone of multi-generational wealth, a tool that basically acts like a financial time capsule. It's called a dynasty trust, and it is engineered for one primary purpose: to keep wealth in the family, not just for your kids, but for your grandkids and their grandkids, potentially for centuries. So how on earth does this work? Well, it's actually pretty brilliant. An individual uses their one-time generation-skipping tax exemption when they put the assets in, and once that's done, that's it. All the future growth, all the compounding on those assets, for literally hundreds of years, is permanently locked away from the estate tax system. And by setting it up in a state like South Dakota, which lets trusts last forever, you've just created a vehicle for nonstop, uninterrupted compounding. I mean, this really drives home the scale of thinking we're talking about here. This is so far beyond planning for your own retirement or for your kids. This is about architecting a financial legacy for your great-great-great-grandchildren. It's the tool that families whose names are basically synonymous with wealth use to make sure that legacy lasts. Now, as powerful as these tools are for families, believe it or not, they're just one piece of a much, much bigger global puzzle. When we zoom out and look at the corporate level, the complexity just goes off the charts. Whoa. Yeah, when big corporations operate around the world, this is the kind of maze they have to navigate. It looks completely overwhelming, and honestly, that's almost by design. Every single number on this chart is a negotiated rule that decides how money flows across borders. But buried inside all that complexity are massive opportunities. For instance, just look at the tax on film royalties coming out of Armenia. If a company routes that money through a treaty with the United Kingdom, the tax rate is just 5%. But if they don't have a treaty in place, boom, the rate doubles to 10%. All of a sudden, a simple decision about where to legally house your intellectual property becomes a multi-million-dollar calculation. So you might be asking yourself, why? Why build these unbelievably complex structures? Whether it's for a family or a global company, it all comes back to one single core, incredibly powerful idea. The ultimate goal, the end game, is to take a family's core assets and just lift them out of the tax system. This isn't about dodging this year's income tax, not at all. It's about freeing capital from the constant friction of transfer taxes, the taxes that would otherwise chip away at it every single generation. It's like taking the brakes off of long-term compounding. And this timeline just paints the picture so clearly. The impact is staggering. Think about it. By using a dynasty trust to skip a 40% estate tax hit every generation, a family's capital grows on a completely different trajectory. After 100 years, instead of getting taxed down twice, that original money has been compounding nonstop, creating a vastly larger foundation for all the generations to come. So this brings us to a fundamental question about everything we've just looked at. It's really easy to see these complex tools and think they have to be some kind of secret loophole or a shady workaround. But that's not the whole story. And here's what's so crucial to understand. These tools are not loopholes. They are features, not bugs. They are intentional, planned-for parts of the tax code and the legal system itself. They are, in a sense, legally engineered components designed by experts to achieve very specific goals, all within the existing rules. And that leaves us with a final and pretty provocative thought. When we look at this whole parallel financial architecture, are we seeing a flaw in the system, or are we actually seeing a different part of the system that is, in fact, operating exactly as it was designed to? It's a question that gets to the very nature and the very intent behind the architecture of wealth.